There we go. All right, I'm on there, I'll move it all this way. All right, so, you guys, I posted the videos for last week, labeled them. Anybody have, just let me check with you, if they're supposed to be helpful, any comments how I can make them more helpful? I looked at them, and the board was small, but it was readable. The screen came across, and I thought rather than just me presenting, I thought it'd be better if I did the class, because if something's not clear, people can ask a question. I've never seen it where one person asks a question. So let me know how that works out, if it's worthwhile. And the reason they're good for 202 is 201 has a YouTube video on every topic. 202 does not. So this will be the video for the course. Okay? Yeah, and just do keep me posted if there's anything I need to do different on that. So just, it's worth doing. All right, should we get on to chapter 2 then, or chapter 11?
Yeah.
Okay, so for chapter 11, we're talking about liabilities, right? Now, and of course, liability is debt of a business. Now, here's kind of a, don't forget, the way this is presented, and I thought the textbook did a good job of presenting it. It's past, present, and future. Okay? So basically what it is, it's a past transaction. Okay? That creates a present obligation to be paid in the future. So, in other words, if you buy something from your supplier, then you bought it in the past, you've got a present obligation to pay them, and you'll pay them in the future, right? That'd be accounts payable. Anybody who needs to sign the roll? All right, here you are. Junior, I'll hand this over to you. Okay. And Junior, when you're done, do you want to just hand it back this way? Okay. Anyway, so now here's an interesting thing is, when the Yankees hired A-Rod and they agreed to pay him $30 million a year, something like that, it's quite a number. Anyway, is that a liability? And the answer is no. Now they're going to pay him, but it's contingent upon working. So at this point in time, that would not be a liability. Now it has to be disclosed in the note because let's face it, 30 million is material no matter who you are, right? Or whatever, it was quite a large number. Was it bigger than 30 million? Yeah.
How is it not an obligation or a liability?
They don't, at this point in time, now if he works, then they've got to pay him.
So you're
When
talking
he
about
works-
just at the beginning of the contract negotiation is what you're referring to?
Yeah, exactly.
So you're entering into the negotiation, you're taking the 30 million as the offer, but until it's accepted.
Not quite. It's more the idea that if he works, he's earned the money, they owe it to him. Until he works, it's not a liability. So for instance, suppose he got busted for drug use, and his contract expired. There's no liability, because the liability occurs when he works, when he plays a ball game. He plays a ball game, they owe him X number of dollars. Until he plays that ball game, they don't really owe him anything. But the contract says, if he plays the ball game, then here's how much we owe you. So the fact that he signed that contract, now they have an obligation to pay him if he plays the ball game. No ball game, no obligation. So that's an example of where there's no past transaction, he didn't play anything, it isn't a present obligation, and they won't pay him in the future. However, when he plays the game, that will. Tiffany?
Okay, so what about recently there was that whole thing where the Battleground School District Board person or whatever, like something happened or whatever, and she had to resign, and she still got the it was $412,000.
Yeah, that's...
And so there was no transaction.
Now the name for that is what's called a contingent liability for that particular one, and that's a little bit different. So I'm going to mark this thing before I forget while it's here. So what happens with that, that's a little different, is a contingent liability, is a potential liability that can turn into a real liability should something happen. So in this case, that would be a contingent liability. So what it would say is the fact that if I get fired, I don't know what it is, but suppose there is something like, if this lady is let go prior to such and such a date, you'll agree to pay her such and That's a contingent liability,
Okay.
in that it's a potential liability that can turn into a real liability given some event.
Okay.
The one with A-Rod is different. It's the idea that if A-Rod plays, then we'll pay him such amount. But until he pays, we don't owe him anything. Okay? All right. Now, and of course, basically, don't forget a current liability. A current liability is paid within a year. Or what?
Or less.
Or an operating cycle, whichever is greater. Whichever is greater, and I'll just leave out the word, just whichever is greater, okay? And then you have a long-term liability. So if a current liability is paid within a year, an operating cycle, whichever is longer, was a long-term liability, it's due beyond a year. Or an operating cycle, whichever is longer. And I'll leave that phrase out if you guys, okay, remember it, okay? All right, now, sometimes we have what are called known liabilities. And of course, a known liability means you know who you're going to pay, how much you're going to pay, and when you're going to pay it. And it's things like accounts payable, sales tax payable, unearned revenues, etc. Okay? Let's start with sales tax payable. So here's how sales tax payable works. There's a $6,000 sale, okay? And there's a 5% sales tax. And of course, that means that the sales tax itself will be $300. Now don't forget, a sales tax, now it's a retail tax. It's a retailer, and of course this retailer is acting as an agent for the county, state, whoever this is, and they collect the tax from the customer. So in this case, here's what the journal entry will look like. Cash will be debited for $6,300. And where do we get the $6,300? Well, there's a $600 sale. There was a $300 sales tax, so your customer owed you $6,300. Okay. Sales is credited for $6,000. And you have a sales tax payable of $300. Now, sales tax payable, what kind of an account is sales tax payable? It's a liability. It's really not your money. You collect it from the customer, and then you have to send it in. And the way these things are set up, almost all these things are set up, is they'll ask you to send it in at various periods. So if you are Safeway, often you send it in every second or third day because you accumulate it so quickly. If you're a small business, often you send it in quarterly, monthly, quarterly. So they'll ask you to send it in such that you don't accumulate too much. That worries them, but not so often that it becomes burdensome. So if you're something like Safeway, you send it in every other day because you've accumulated such a huge number. They don't want you, okay. And if you're a small business, it can be, if you're a really small business, it can be quarterly. And that's how they set it up. Normally what they'll do is a brand new business, they'll have something called a look-back period. They're not a brand new business, and they'll take a look at maybe the previous year. And then that will determine how often you should send it in. Okay? All right. So we can move this into long-term memory. Why don't we do quick study 11-2, and you find it on page 462. So I'm going to turn the camera forward, turn out the lights. And here's how it reads. Now, I've opened all those back ones, I'll open another one in a minute. It's easier to read, so, but let me put this in the board before I do that. So it's page 462, okay? And here's how it reads. Okay, so what it says is, let me put this up here to make it large. I'm going to fold it in half, so it's like that, with this here. All right, so the record company sells merchandise for $5,000 cash on December 31st. The cost of the merchandise was $2,900. All right, so they must be doing this on the perpetual system, so you guys will have to put some thinking caps on, right? The sales tax law requires the record to collect 4% sales tax on every dollar of merchandise sold. Record the entry for the $5,000 sale and the applicable sales tax. It also record the entry that shows the remittance of the 4% tax on the sale to the state government on October 15th. So we didn't go over the last part of that, but you guys are capable of it, so give it just a little bit of thought. So you guys, you ready? So what you want to do is, the sale will look like this, right? And then, of course, when you send it in, then, of course, you'll debit the sales tax payable and you'll credit cash. Is what the October 15th entry will look like. So with those hints, let me turn you loose, and I'll put the answers up in a minute.
Steve,
Yeah.
we're not worrying about cost of goods sold at
Yeah.
this point.
That is part of the problem, yeah, when they give you that information. So do the cost of goods sold. It's on the perpetual system.
Then when you pay the sales tax, you just debit it from the
And this is probably a good review, because there's a good chance you may have forgotten that.
Maybe not sunlight.
All right, sure, let me just put this up here, so it's set up.
Maybe that edge will adjust.
Well, no, I just couldn't do that.
I'm gonna try it out.
So let's try this, let's see, if I do this. Maybe that's too much, let's
It's
try
fine.
this.
No.
No, the other one?
It's just moving off, it's fine.
Are you sure?
I should eat more carrots anyways.
I'm sorry, what?
I said I should eat more carrots anyways.
Okay, all right, well, if I do that, all right, you guys all got your books, right?
Yeah.
Okay. All right, so let me put up some of these answers as we go along. So this is what the sale looks like, right? So in other words, here's the sale, 4% of that is $200. Add those two together, and that's the amount of cash you'll get from your customers. Does that make sense? Now, it's on the perpetual system, so don't forget, your cost of goods sold will be $2,900, and then inventory's credit for $2,900. Remember the perpetual system? All right. And then, on the 15th, you're gonna send us $200 in. So you're gonna debit the liability and credit cash. All right. Now, what questions do you guys have?
I
Any?
have a question.
Yeah.
So it says that they sell merchandise for $5,000.
Okay.
And they have to collect sales tax.
Mhm.
That's just the way it is. If the sales tax is included, would they tell us that? Because
In
it
the
says they only,
5,000?
it says they sell merchandise for $5,000.
Right.
But I was unclear whether or not the sales tax was already included in that price.
Well, you know, it's
Because-
the same here in Washington, right?
Well, no, I understand why it works, but like,
You're thinking
I
how
looked
you...
at it to assume that they were receiving $5,000 cash, and that a portion of that was the sales tax. Because it doesn't say that they received $5,200 in cash, it says they sell it for $5,000.
It is a sales
Okay,
tax.
the deal is, yeah.
So,
Don't forget, an asset is different than revenue. So what they're saying is our sale was $5,000. And then the sales tax will be in addition to that.
okay, so if it was included, would they make that clear?
They'd have to make it clear.
Okay.
And it'll never be included.
Well, then, but they told us not.
I'm sorry, what's that?
No, I mean like, no,
Yeah,
I get
hey,
it.
listen, here's the best answer. Assume that it's not included unless they tell you otherwise.
Okay.
And when I say never, that never works in accounting. There's never a never.
But
There's
there might be
never
a
always.
problem where it says
Yeah.
they received
So,
this much in.
but
on
assume
tax.
that when they say a sale, they're talking about the sale.
Just the same.
And that anything else, such as the sales tax payable, et cetera, will be in addition to that.
Okay.
Assume that all they're talking about, hey, you guys? Hey, you guys. All right. If you got a question, we'll be glad to answer it. All right, okay, all right. Tiffany, you're blaming it on Michael, right? Okay, all right. If you got a question, be sure to give me a yell. But hey, I hope I'm giving you a good answer in that, right?
Yeah,
And
so
when
just
they-
assume
when they-
it's not included
sure.
unless they say it
In
is.
accounting, when you go on, when they say a sale, they're talking about revenue.
Just right. Okay.
Generally, that's, from the lingo, that's what they'll be. You guys doing good? Yeah.
So if it's going in the cash account, can they use that money all they want until they have to go in for operations?
Exactly, so, yep, that's exactly, just make sure you got the money when it's due. In fact, this is maybe a good answer to that. It was, what happens on this thing is, when they collect the money from the customer, when they collect the money from the, here's the way, right? What happens in this thing is, when they institute a sales tax, people swap. Everybody but the merchants. And the reason they don't is because they, there's a penny's the smallest thing we have, right? So if it's like a 6.8% sales tax, they always round up to the nearest penny. And the difference between what the sales tax is and the next penny is profit.
It's small, though.
Yes, but when it happens thousands and thousands of times, it adds up.
When you're a billion-dollar company,
Yeah,
like
and-
Walmart or something.
yeah. And it's all automated because it's all done in the cash register. There's no labor involved. And there's enough money made when they round everything up, a fraction of a penny, that it's worth their while. So the merchants don't complain when they institute sales tax, because every sale is an additional fraction of a penny profit. Yeah, and one year Safeway had a bad year, and they looked at the income statement, and the only profit they showed was that sales tax. Yeah, and it was just that 1 year. Yeah. And, yep. All right, so let's get into unearned revenues, okay? Now, in this case, don't forget, unearned revenues, remember that's the liability account, right? What does it represent? Represents the prepaid. Get the light? Camera. Oh, it should be, oh, camera turn. That's exactly right. Man. All right. There we go. All right. So I'll set this one. Thank you very much, because I did forget that. All right. So listen, what are unearned revenues to remind you? Well, it's an advanced receipt, right? Like ticket sales is an example, that's exactly right. So what happens on this thing, if you buy a season's ticket to something, then it's in fact, this is an example. So any sort of a prepayment, any sort of advance payment that you'll earn later is unearned revenue. Because if you have a ticket sales, like you buy a season ticket, then that's from the company that sells you the season ticket, that's a liability, simply because when you receive the advance payment, it's not your money, you incur the debt. Okay? So, we're talking about unearned revenue. And unearned revenue is a prepayment. I thought I'd just try this to see what it did. I think I better go back to the other one. Unearned revenue, we're talking about a prepayment that's later earned. So in this case, it is a ticket sale. So Beyonce sold 5 million in tickets for 8 concerts. So on June 30th, cash is debited for 5 million. And unearned ticket revenue is credited for 5 million. Okay, so this is when Beyonce sells the concert tickets. Okay, that's for 8 concerts. So if we have 5 million divided by 8, every concert is worth $625,000. So on October 1st, she performs a concert. So October 31st. At that point in time, she's earned $625,000. So unearned ticket revenue, which is a liability account, will now be debited for the $625,000 that she's earned. The credit will be in revenue, and it's called ticket revenue. And that would be the $625,000. So the way this works is when you receive the prepayment, you debit cash and you credit the liability, an unearned revenue account. When you earn the money, then you debit the liability because you don't know it, you've earned it, and you credit revenue because you've earned it. That make sense? Yeah.
Where'd you get the 8 for up at the top?
It's a given.
Okay.
And what it says is she received 5 million for 8 concerts.
Okay.
And that, just like, it's just a given, okay? All right, you guys are okay with that? Let's do some practice. Let's do quick study, 11.3, page 462. Okay, it's just below the one we just did. Okay, so here's 11.3. I'll turn on the light in just a minute. So ticket. So the way that reads is what it says is Tickets Incorporated receives $5,500,000 cash in advance ticket sales for a 4-day tour of Bruce Springsteen. Record the advance ticket sales on October 31st. Record the revenue earned for the first concert date of November 8th. Assume it represents 1/4 of the advance ticket sales. All right? All right, how's this for an answer? So here's what it looks like when the money's received. You debit cash for the money received and you credit the liability count, honor and ticket revenue. Here's what it looks like when you earn it. Okay, so here's the amount of money divided by 4, so 1/4 of that's been earned, or 1,375,000. You debit the liability and you credit the revenue. So good? All right. Okay, questions, comments, you guys doing good? All right, now, let's go ahead and do another topic. Let's go over to the other page, excuse me, other board, so I do keep all of this on one board. And, because it's kind of, it has several parts to it. Okay. All right, so now we have notes payable. Okay, so don't forget a note is an unconditional, so a note is an unconditional promise to pay. So it's a promissory note. Okay, and a promissory note is an unconditional promise to pay. Okay. So, what happens in this particular example is the accounts payable is $600. And this person calls up the supplier and says, listen, I'm going to pay it. A little bit short of cash, so I need some time. And the supplier says, fine, we'll need to transfer that to a notes payable. And the reason is because the notes payable is easier to collect than the accounts payable. Okay? So, specifically in August 23rd, there's a $600 accounts payable that gets debited. And this person says, listen, I'll send you $100, okay? And we'll put the rest on a note. So actually, a guy should never talk and write at the same time. And I'm really glad when I do things like that, because it really perks people up and it makes it memorable. Now you'll remember. All right, does that make sense? Okay. All right. So here's what it is. And this, what happens in this thing is the supplier says, I need a note. So you credit notes payable, it's a liability. The person who owes the money agrees to send the $100, and then the accounts payable is removed. So this is converted into that, less the payment. Does that make sense? Yeah.
How come notes payable is easier than accounts payable?
It's easier to collect. It's an on-condition promise to pay. So an accounts payable is certainly collectible, right? But maybe you'd say, well, I didn't receive the goods, right? Or the goods were damaged, or whatever. There's just a lot of leeway. When you sign a note, it's an unconditional promise to pay, and it's just really hard to get out.
Okay.
And it's easier to collect on, and the collectability is shorter, because there's just less proof, less of a burden of proof. There's a, Michael, is that the hand? Okay, doing good?
They will normally have interest too, don't
They do? Yep.
So
And there's some interest involved there
Accounts
too.
payable, you don't have interest.
Not
That's another
normally.
reason to switch it to
Mhm.
notes payable.
It could even be similar to the master promissory note that you sign if you do student loans. You know, it's an unconditional promise to pay regardless of what the outcome is.
Of course, and the thing that's unique about that is you can't even discharge it through bankruptcy, because a lot of notes you can. Yep, and they often do have interest. And of course, the other thing is, you know, if you buy a car, often it's secured with a note. A bank loans often secured with a note. Yep, and they're interest bearing. In fact, that interest bearing, let me go ahead and follow that. And so now what happens on this thing is, okay, all right. Now what happens on this thing is, a 60-day note. It's a 60-day note. So now on October 22nd, it's paid. So in this case, if we have it, so basically what it is, it's a 60-day, 12% note. Okay. All right. So in this case, it's, the way you figure interest, it equals principal times rate times time, right? So in this case, it's a $500 note at 12%, and this will be 60 360ths. Now, we used the same book last quarter, right? So you know what's with the 360? It's a banker's year, okay? So on the quiz, on the test, they'll always use the 360-day year, okay? All right, so in this case, the amount of interest that accrued within those 60 days was $10, okay? So interest equals principal times rate times time, so it's a $500 note, 12% interest, and 360 days, that's how long it was, okay? So it's the number of days over a year. In this case, it'll always be a banker's year, it'll always be 360 in this book, okay? And this was used up until, I don't know, less than 10 years ago, whatever it is, time flies, it's hard to judge, but up to 10 years ago, they used the banker's year. And the pretext for using the banker's year is that it was easier to work with than 365, but that's not true anymore when you got calculators in Excel. But they did keep it, and of course it's slightly to the bank's favor. Not much, just a little bit. But if thousands of transactions over centuries, it adds up. You thought that rounding it up every fraction of a penny, every sale was something, right? And we're only talking about years. These guys are talking centuries. Yeah.
Well, the reason I was concerned about it, because it's relative to what? There's other ways to find savings if to streamlining operations or something like that.
Well, you just make it every way you can, I think, is more the point.
Yeah.
You know, here, there, that sort of thing. Yeah.
Tim, you shh.
And what?
Tim shush.
Tim Shush?
Yeah, Tim shush.
What's that? I'm not sure what that means.
We don't need to know about all those other ways you can make money.
Oh, I see.
I'm just teasing him.
No, but the point's the point's taken. It seems like a minor thing, but you can make it here and make it. So in this case, if it was a sale, they'd round up the nearest penny there, and then they have this interest, and they're 360, so a few more pennies there. It adds up. All right. Okay. So in this case, here's where they convert the accounts payable into note payable. Now here's where they pay it. So when they pay it, the note payable is written off, so you debit the liability. Interest expense, of course, will also be a debit. Okay, will be a debit of $10. And the total cash is spent, will be adding the two together, so that's a credit to cash for $510. So here's where they convert it into accounts payable, and here's where they pay it. Okay? All right, does that sound good? Yeah.
So we're the company that can't pay the 600.
Exactly.
Okay.
We're the company that can't pay the 600. So an accounts, if I've been reversing those, am I
A little.
I didn't
I
mean
just
to,
wasn't
I've got to
exactly
watch
sure.
that. So an accounts payable means we borrowed from our supplier, we convert it into a note payable, and here we're paying it off. Yeah, okay, all right. Okay, now, let's go to a little bit of a different one. So now what you do is you borrow money from a bank. And I'm going to, I need to conserve in board space, but I'm going to move over here because this is too confusing. So you borrow money from a bank. Okay, and you borrow $2,000. Okay, that's a 12% note, and it's a 60 days. Okay, now what happens here is on, okay, and it works the same way. So in this case, what you do is on September 30th, when you borrow it, you debit cash for the 2,000, and you credit notes payable for the 2,000. Now, on November 29th, 60 days later, you pay it. And so it's principal times rate times time. So now the principal is $2,000. The rate is 12%. And this is also a 360-day year. So now the interest for this is $40. So when you pay it, notes payable will be removed from the books with a debit. And so this note payable is that note payable. You have interest expense of $40. And you add the two together, that comes to $2,040. That's a credit to cash. So here's what it looks like when you pay back the money borrowed from the bank. Okay. Now, let's make this a little bit different. Instead of borrowing it on September 30th, let's say you borrowed it on, let's say what you did is you borrowed it on December 16th. So now on December 16th, what you do is you borrow $2,000, okay, 12% for 60 days. And I'm going to move this over here because I think it'll look better if I stack these. It'll be more clear if I make these. So what you do is you borrow $2,000, you borrow $2,000 for 60 days, okay, at 12%. So on 2011, you have December 16. Okay, so let me start out with this. So on December 16th, you have a cash of 2,000, and you have a note payable of 2,000. Then on December 31, what you have here, so December 31, you have the end of the year. So this is an adjustment. And so December has 31 days. 16th is the date you borrow. There's 15 days of interest. So this is the, December has 31 days. The date of the note is the 16th. And so there's 15 days of interest. Okay? So it's principal times rate times time. $10. Okay. So I'm going to put it in here just to be sure. So it's $2,000, right? Times 12% times 15, 360th, and that came out to $10. So you have an adjusting interest at the end of the fiscal year, and so that's interest expense. That will be a debit of $10, and at that point in time, it's interest payable of $10. And of course, this is an accrued expense, right? Yeah.
So when you make the adjustment,
Mm-hmm.
do we need to have a line item showing the adjustment entry in the journal?
Well, yeah, normally all adjustments are just done together. You just start out with the word adjustments and you adjust all the accounts that get adjusted. Then when you post this from the journal to the ledger, you know that it has that column in there that says
TR.
descriptions. well, not the PR, but there's a column in the ledger that says descriptions. Almost all of them are blank. If for some of these, and I hope I'm answering your question, and so, but what goes in the ledger are adjusting, closing, reversing, correcting.
Right,
Yeah.
and what I'm saying is on the actual journal entry, so we've got on December 16th, cash, note payable,
Mhm.
but then we realize it's end of the year, the 31st
Okay.
comes in, so we've got December 31st.
Mhm.
Do we need to have December 31st adjustment entry and then itemize them?
Mm-hmm. So exactly right. So hopefully this answers your question. Normally what you'll do is you'll just write the word adjustment. And below that then you just do all the adjustments. And if you do it that way, then there's no more, there's no need for any, thank you very much, Junior. There's no need for any other explanations. But Michael, am I answering your question?
No, you are.
Okay. If I'm not, I'm going to move this up here. There's the end. All right, that'll take it to the end. Okay. So in that case, and then 60 days later, on February 14th, and that will be in 2012, you pay it. So now the interest expense will be debited for $30, okay? And so, and where that works is if it's a 60-day note and 15 days is worth 10, that leaves 45 days left, and this will be, if 15 days is worth 10, 45 days will be 3 times greater, so it'll be worth 30. Does that make sense?
Yeah.
So you could have figured it by putting 45 over 360 and got 30, or 45 is 3 times 15, so it'll be 3 times greater. Either of these are the same numbers. You go okay with that? Anybody want to see what's worked out or anything? Okay? All right, so in that case, then you have interest expense of 30. You'll have interest payable of 10, and this is where that came from. You have note payable of 2,000, and this is where that came from. You add all those together, it comes to 2,040, and that will be a credit to cash. Does that make sense? And by the way, and just sometimes it's easier to learn. Let me jog your memory, because don't forget we did this last quarter. But it's been a whole summer. Lord knows what a person can forget over a summer. Okay. So I'm doing this. The honor and revenue should be reviewed too. But if I point out that you relearned it somehow, then you remember, oh yeah, I did learn, come to think of it. Yeah. Right with you, Michael? Yeah.
I just had a question about the notes payables. So say it's a 60-day note. If
Okay.
they paid it off in 30 days, we're still charging for a full 60 days with interest.
It
though, right?
depends how it's written out. Because, you know, there's a prepayment penalty.
Yeah.
Sometimes there is, sometimes there isn't. Sometimes if you pay it early, you just pay the interest on what, yeah, depends how the contract is written. No prepayment interest, then the interest would stop the day you paid it off.
With banks, do they go one or the other usually?
Just got to see how it's written up.
All right.
Yeah. Yeah, Michael?
Do you mind showing the interest expense, how you came up with the 30,
Sure.
just to show the math?
Sure. So in other words, it's a 60, and by the way, I sure appreciate your asking, okay? So listen, it's a 60-day note. Now, 15 days occurred in 2011 between December 16th and the end of the year, right? So in that case, if there's 60 days, 15 leaves 45 left. So in that case, what happens on this thing is 15 days occurred in 2011, and the remaining 45 days will fall in 2012. Does that sound good?
Yes.
All right. So it's principal times rate times time. So in this case, it's a $2,000 note, and it's a 12%, the rate's 12%, and now there's 45 360ths. That'll turn out to be $30. Okay, and so 60-day note altogether, 15 was between the date you signed it and the end of the fiscal year. That meant the remaining 45 will fall in the following year. Okay. All right, okay. And then don't forget, the way this works is the date the note is signed, there's no interest. So that's why if you take 16 from 31, 15 days of interest. This may be another thing I need to kind of remind you about. Okay? So let's do this. Let's do quick study 11-5. You can find that on page 463. Okay. Now, you may have to check your phones or something to look at the calendar. I'll go ahead and put this on the board. So that's quick study 11-5. I'll put it up here. So I'll turn that camera now so that our viewing audience all right, I'll do that. Okay, so let me put up 11-5. Here it is. So what it reads is, on January 14th, okay, so here's 11, oh, I'm sorry, here's 11-5, one above it. On November 27th, Ortiz Company borrows $150,000 by signing a 90-day 8% note payable with a face value of $150,000. Okay. Compute the accrued interest payable on December 31st. Prepare the journal entry to record the accrued interest expense December 30th, December 31st. Prepare the journal entry to record the payment. Okay. Now, by the way, don't forget you got to figure out the date. So it turns out there's 54 days of interest because there's 30 days in November, right? And you signed it on the 7th, so there's 23 days of interest. Does that sound about right? Then there's 31 days of interest in December. You add those together, so there's a total of 54 days of interest in the first year. That sound good? Yeah. All right. And I'll just put that up there. Okay?